Hi, this is Randy Finney with Right Side of the Chart, and today is Friday, January 6, 2017. Happy New Year to everybody. I wanted to do a quick overview of not just the equity markets, but a few of the things that I pointed out recently. Gold, there seems to be a lot of interest in gold and the mining stocks. Touch on commodities briefly and keep this video relatively short. This is the SPY, the S&P 500 tracking ETF from the daily time frame. So what we've seen recently is I do have various boards, meaning different patterns I've drawn on the S&P 500, but this is something I'm watching, and I believe I posted this one. The white lines here make up a bearish rising wedge pattern. We had a fairly well-defined trend line off the lows here in early 2016, some reactions there. We did have a breakdown. That was leading up to the elections, and then there's the Trump pump following. So what happened is essentially following the elections in that rally, we snapped back into the wedge, came right to the top of the wedge. You can see how well defined that upper trend line is, and have since broken down. This yellow trend line, that's a minor uptrend line. You can see fairly well defined. So we also broke below that. And if we zoom in here, what we can see is we're back testing that wedge right now from below. Come down to the 60-minute charts. This is a chart I've shared quite a bit recently. We had this uptrend line here. We've had a couple patterns. There's the yellow uptrend lines really form a channel. The trading was sort of sloppy at the end of the year. There's a lot of last-minute position shuffling, window dressing, tax selling, all types of stuff go on, and that's, as I've shared with most of you in recent years, the last few weeks of the year, I typically try to avoid trading because you have these whippy signals. But with that being said, the technicals are what they are, and what you had is you had a divergent high here, you had a divergent high here. You can see down on the MACD as well as the histogram, and prices have since broken down, and these are levels to watch. Let me give you a line here. These are rough numbers, 226.68. You can see that's acting as resistance. We've tapped up on that line. There's a gap back here that helps define that level, and then 1, 2, 3 reactions. And this was a support level here. Previously highlighted, we broke down below and have come back up since. And the theme, what I've noticed leading up to the end of the year, and I had mentioned this back when we were rallying right up to highs. There was talk that we would rally right up into the end of the year because nobody wanted to sell with the belief that Trump will be lowering tax rates. And my theory was we'd probably see selling kick in before the end of the year. Why wait till after the first of the year and get caught up in the selling with everybody else? If that's what they were waiting to do, is hold off to the first of the year. So we did actually get that. If you notice, from about mid-December, we did sell off down into the end of the year. If I put the crosshairs there, there's December 30th, the last trading day of the year. So we sold down into the end of the year and did have a little bit of a pop from there, but not a whole lot. So far, trading has been, at least in the broad markets, relatively lackluster, even for months now, but especially going down into the end of the year. It wasn't a really huge sell-off, nor has the rally since the first of the year been much, but these are levels to watch. So if we punch above 226.68, that would be bullish. Your next resistance at that point would be the recent highs here. So that is, give or take whatever that number is. I don't have the line on there exactly, but around 228.20. That's the next level to watch. It's resistance. And if we happen to come back up, let's draw this out for you. Just something to note here. Let's say we do take that level out, but only make a marginal high and then reverse. What that will do is put in another divergent high. As you can see here, if I draw that out and you look at the MACD, which is severely lagging right now, even if it came up a little bit, it will still put in a second divergent high. In fact, it will more than likely be an extension of this downtrend line here. You see how that comes in. And we'd also have that divergence on the RSI, as well as my trend indicator down here, the 1333 histogram. And so there you have it. That would be one scenario for another divergent high. And as I say, these divergent highs much more often than not do play out for corrections, some bigger than others, some are relatively minor, but very often, especially when that divergence is confirmed, it does play out for a correction. There was a divergent high there. They're not all drawn out here. I had it highlighted before. So that's that, and that's one possible scenario, but we may not even get there. This is resistance 220, roughly 226.68. As I'm doing this video, the markets are open, and as you can see, the S&P is virtually flat. So those are levels to watch on the S&P 500. Take a look at the Qs. I was on the 60-minute time frame, so I'll just leave it there. We had right up to towards the end of the year, we had a divergent high and pretty heavy selling in the Qs. You can see that. So there was that last-minute sell-off that I had, anticipated, with everybody not waiting till the first of the year. Now we did get that selling, so therefore we've already had a bounce back, but we're really back to about where we were, a little bit below those recent highs. But there's another example there, as you can see. Let's highlight it here. You had the divergence shown here, here, and here, and of course those divergences did play out for correction. And as I often say, the amount of the correction, although there's not a hard formula for it, it is typically commensurate with the scope of the divergences. In other words, these were divergences lasting just a couple weeks here, and therefore you had a correction that lasted a few days and a bounce back so far. Looks to be, let's clear these out, looks to be very similar to the S&P in the fact that if we do make a new high, it is likely to be a divergent high. As you can see here, the indicators are lagging behind in almost all cases. So I can very much see a little bit of upside and a reversal. So that's something to watch for. We could also draw a minor uptrend line right here. It's fairly well defined. So let's watch for a break of that. Those would be your sell signals on the market. And for those that are looking for, a higher move here or an advance into the early part of the year, then what you'd want to see is all these divergences taken out. By taken out, I mean the indicators here, the MACD, the RSI, any of the momentum or price indicators that you use. If they go on to take out the previous reaction highs, that then negates any negative divergence. I hope that's not a double negative, but it means it takes out those divergences. So something to watch for there. As long as those divergences are in play or potential right now, that's what I'm on the lookout for, due to everything that I've talked about leading up to this. So this, again, is just a quick overview of where we're at here. Daily chart. Here's the Qs on the daily chart. We have that long-standing negative divergence. As I pointed out in the past, each of these divergent highs that you can see here, some of them aren't drawn out. I had those drawn out in the past, the divergences there. They all played out for corrections, and we have a powerful divergent high. This is what I call consecutive divergences. We had a divergent high here. You extend that trend line. We had another divergent high there. They're, again, not all drawn out here. If I took this line, I could show you that at this point there was divergence, and at that peak there was a divergence, and that was the correction that we had here. So we've gone on and put in yet another slightly marginal new high. That was right before the end of the year, the one I was just talking about on the 60-minute chart. And either way, on the daily time frame, we had divergence at that point right there. And if we eke out to another new high right here, that will still be a divergent high, again, unless these previous reaction highs are taken out. And therefore, we're looking at really the bigger picture. Let's strip all that away, focus on these yellow trend lines, and this draws a very large, powerful bearish rising wedge pattern, complete with negative divergences. So this is the big picture that I'm looking at here. And if this plays out the way that I would expect it to, you're looking at a fairly large move. One rough estimate to take the measured move of a rising wedge pattern is you just measure the widest point of the wedge, which we have here, and you add that to the point which the wedge breaks out. So you can see I have support zones down here. These are target zones. And that would be a very high probability target, this major S1 zone. That means first support zone. This S2 zone I labeled critical. Critical because I believe if that level is taken out, that will just open the door for a waterfall sell-off. So one possible scenario, maybe we go down, visit either of those levels, and then bounce back up. But again, something to watch for. And as of now, the technical outlook for the markets still looks bearish, despite a trend that appears to be extremely, and has been extremely resilient. I'm referring to the larger trend, but as swing traders, we can trade and game these bounces here. I don't have all the divergent lows marked, but in some cases I do. So swing trader, you want to short the divergent highs and buy the divergent lows, as well as some other buy and sell signals you want to see align with those. All right, so that's QQQ on the daily time frame. That leaves one more that I like to cover, and IWM. That's a messy board. Let me pause the video, see if I can find a clean board. Okay, I like this one a lot better. It tells a similar story to the SPY. If you recall, when I started out, we had a fairly well-defined uptrend line on the daily chart. We are on the daily time frame. If I neglect to mention, just look up here and you can see the time frame we're dealing with. So you had a rising wedge pattern, and as with the SPY, we had a breakdown, and it was a pretty impulsive sell-off, again, leading up to the elections, but the U.S. presidential elections changed everything. We had, the expectation, as you all know, that Hillary would take the election. Trump won. A lot of traders were positioned caught off guard. Was bullish for the bank stocks and some other things that really helped lift the markets. And for whatever reason, that sometimes the fundamentals or certain other factors do foil the technicals. So this breakdown, by all accounts, looked like the real deal. And to be honest with you, it actually played out to about where it should have. If, again, you take the widest part of the wedge and then you add that to where prices broke down, that's not too far off the measured move of the target. So it broke down. However, the trend lines still seem to be valid. It looks like a larger rising wedge. So what we have here, and I've seen this before, prices break down from a wedge, shoot back within the wedge. We had even what some of you know I like to refer to as a wedge overthrow or overshoot. We had that there and then snap back into the wedge. So either way, I know it looks a little bit sloppy, and personally, when I see a trend line or a wedge or any chart pattern traded through too many times, it takes away from the validity of that pattern. However, I'm seeing a lot of reactions off these levels. You can see how prices have come back in. They respected the wedge when they entered it again here at the top, finally had an overshoot, but we've respected it again on the bottom right here. And so really where we're at, we're pinching close to the apex of this wedge. There was a very steep bearish rising wedge with these white lines here that broke down. And that point there, we had let's see if I can do this. We did have a divergent high there as well, small divergent high you can see on the daily. And so let's watch this trend line here. And now zooming down to the 60-minute time frame, we can see that we had a bearish rising wedge. I pointed this chart out many times over the past month or so here. You can see the divergence with all the indicators and momentum price and indicators and momentum oscillators, or I should say they're typically price oscillators, momentum indicators. And you can see the divergent high number 2 there. Prices have since broken down, but sort of traded in a sideways range. Not sort of, very much traded in a sideways range. So this is what we're looking at here. So we need to watch on the small caps for the next definitive break, definitive by meaning impulsive, not a little limp through down here. You can see the bottom of that S1 support zone at 135. We've briefly moved below it. That is not what I call impulsive trading. You didn't have high volume. That was right at the end of the year. So now the new year's underway. So let's look for a definitive break of either the 135 level or the top of that resistance zone, which is around 138.15 or so, and that should tell us where we're going. Any new high, again, as I covered with the S&P 500 and the Qs, if you look at this, it would just be an extension of these larger divergences that were already put in, or the previous divergences that were put in place. So to draw that out, and it almost looks as if we're going to get that just looking at these charts. I think it would really help the case for a short trade if we pop to new highs, because what that does, that would be a false breakout, aka bull trap. You'd have a lot of longs or some wannabe longs that are on the sidelines enter. You'd have some shorts cover, clearing out that short interest, and doing so makes the way for a powerful move. Because if it fails, we have that second divergent high. You have the longs that jumped in, realize they're wrong, they turn around and sell. You have the shorts that covered. Now that short interest is cleared out, so that makes room for a larger drop. Remember, when you have a very high short interest in the market or a relatively high short interest, you have a lot of guaranteed buyers, so shorts must cover at some point. So when you can clear out short interest, that helps the bearish case. So that would be an ideal scenario. But again, let's just watch these levels and see how they come. All of these green lines here are potential price targets should the IWM reverse, and I favor a move down to at least this 125.80 if things play out the way I had highlighted it here with these false breakouts and other divergent highs. Okay, moving on to the precious metals real quickly. I did a detailed update on these just recently. Here's gold, that very steep bullish falling wedge that I talked about, and we did break out of that, and since we broke out, as you can see, it's been a relentless and powerful uptrend. So a nice move in gold. These were resistance levels that I had before. That was a target on the downside, which would be a target on the upside. That was a pretty significant support level. It was a target back here that I had earlier in the year in 2016. Then again, after the divergent high here, we exceeded that target. But again, then laying the groundwork for a reversal in gold and the miners, and so far that has been the case, and pretty clear. That's what you call an impulsive move. Not huge volume, but a pickup in volume so far on the rally. So gold looks good. The other shiny metals we have are silver. There's that support buy zone that I talked about even before we approached it. We got inside, gave a lot of opportunities. And as I mentioned, my preferred strategy, because I wasn't as confident on the exact timing of this, it looked like gold and silver and the metals were coming to a buy area. And so, as I mentioned back in, I believe, November or early December, my preferred strategy was to scale in during these zones. And what that means is you don't buy above, you don't buy below, you don't have to necessarily sell everything if it dropped right below. You give it a little bit of room, but you scale in, and then what we've done is broken above the top of the zone, and then this downtrend line sort of wedge pattern. Silver's lagged behind gold a little bit. But it overall, this is a pretty bullish chart here. You had a breakout. Now this is a support level around 1558. Resistance levels. All the horizontal lines are resistance levels or support if from below. And now this would be a pretty important support level. These recent lows down here at the bottom of my support buy zone. But you did have, and most importantly, the bullish divergence here on the PPO as well as the MACD, the RSI, and so far we've reversed off that divergent low. And the one that I pointed out just recently is my favorite, looking really nice, was platinum. And you can trade platinum via PPLT, and it's just a great, we had a big gap the other day, first trading day of the year on Tuesday, and that gap was, what was that, about a 4% gap, 4% move, so out of the pattern, and then it followed through for the next 2 days. This was my first target that was hit. Looks like it was hit, or almost hit on Wednesday. Came above it. So now keep in mind that resistance, once taken out, then becomes support. So this T1 level, which is actually at, if I hold the crosshairs here, tells me that's at 91.43, give or take. That's support now in platinum, just like silver was coming back on support. So let's see if these levels hold. If they don't, the next support would be down here on platinum around 89, call it 89.50 or so. You see this candlestick here, the bottom of that gap, that's always a significant level. And if you go to the left, you can see some reactions back there. So those are your levels to watch if you're looking to either enter or add to PPLT. Pull back to either that T1 level or that support level there. And of course, these are the next upside targets. Very strong divergent low, and clean divergence as well on this one. So and a nice bullish falling wedge pattern. We had one little false breakout, but other than that, the pattern was fairly well defined. And then I know a lot of you trade, and myself including, the miners, because if you get the call right on gold or silver, you usually can do a lot better percentage-wise in the miners. They tend to move up or down more in percentage terms, and ultimately they'll track gold and silver wherever they're going. So you had a divergent low, everything again that's already been covered. Divergent low, this was a buy scale-in zone. We slightly exceeded that. So again, what I was referring to earlier, when I have a buyer scale-in zone, I'll buy down in that zone. I won't buy below it. I'll hold off. Stops will be, the technical case was never taken out. It was never damaged, but that's just how I trade those. So we still had a divergent low there, even when we popped below it for a day. And we may have even closed back above it. That's a green candle. That means we closed, right back at the bottom of the zone. So we really never closed below. If you zoom in, you can see how beautiful technical analysis works. That was the $19 level. And you can see that the days that we did, get down around there, we closed either right on it or bounced above it and closed a little bit above it. And then since moved out of the channel, and once we got out of that, not channel, support buy zone, then we saw some pretty impulsive buying. You can see the big, look at the volume bars down here, big white or gray volume bars, big impulsive green candles. That's what you want to see. That's bullish price action. There was a downtrend line. That was my first target zone. It was already hit. We've taken that out. So now this downtrend line, as well as this level here, 2210, call it, that is now support. There's another level there, the top of the zone around 2250. So gold looks good, but it may keep in mind it may need to take a breather here. It's a move of in just a couple weeks from high to low. That's about a 25% gain in GDX. You can't expect it to shoot straight up forever. Although the thing about GDX, it can go on a relentless uptrend. It's hard to say right now. Personally, I have no desire to try to game this one right now, trying to game the pullbacks. I have the position I scaled into, and as long as the technicals look good, I'm planning to hold this one as a longer-term trade for now. But if anything changes, I'll let you know. 60-minute charts, really didn't have a chance to update these before I got here. There's a little bit of a divergent high, very small. If I draw it out here, you can see this on the 60-minute time frame. So maybe a little more downside wouldn't surprise me at all, especially considering the run-up that we've had. We might need to work off those near-term overbought conditions. Forget about everything back here. So this is what I'm looking at. So maybe we pull back down here. There's plenty of support below. That's the good thing. And I'll try to give you an update on some of the levels. I'll study the 60-minute charts a little bit better, daily charts, and maybe put up some static charts for you guys. Looking to really either micromanage these trades, meaning take profits on the rips and reposition, or even short the pullbacks and then buy back in. But right now, the longer-term case still looks good for the metals. Okay, we'll touch on bonds real quickly. I don't want to spend too much time. Again, those have been covered somewhat in detail over the last few weeks here. And this is TLT, the government bond, 20-year plus Treasury bond ETF. This was a falling wedge type pattern. You can see a fairly well-defined downtrend line. We've broken out, ripped above there. There's really not a whole lot of resistance up here to about the 124 level or so. And I over time, we could easily get up here to about the 127.25 level, we'll call it. There's a big gap there. Gaps are often backfilled, or at least tested down from below. And, at this point, one thing I don't see, we had a little bit of divergence if I draw it out here. It's not the clean type of divergence that I like to see. I like to see clear separation, meaning peaks in the MACD or the PPO, in which case I'm using here. This was a little bit of divergence below that wedge, so that did play out so far for a nice move. But somebody asked me about TLT yesterday, and in my opinion, this is in what I call no man's land. No man's land is when a stock or an ETF or a security you're trading is between support and resistance. This is very good support down here, the around the 115, 114.50 level, and I'm referring to the 2015 lows. We never hit those lows. So we may need to come back down, may need to take another thrust down in bonds before heading up. That I'm not sure. So again, I'm just trying to tell you my near-term outlook is questionable on TLT. I don't have any position at this point in time, and I'll let you know if I see anything else. Let's look real quickly at some of the other bonds. Corporate bonds, these are investment-grade corporate bonds, LQD. Yeah, there it goes. LQD looks very similar. The chart pattern, you can see the same type of bottom that with that minor divergence that TLT had, and we turned around rally. These are levels you can see pretty well defined. Resistance level here. You can see a reaction back here in mid 2016. Some reactions back here, and that's where LQD stopped so far. So if it can get above those levels, let's see. We have a next shot up here. There's a pretty nice, that's that comparable gap with TLT right here that I talked about. So if we continue higher in LQD, this is where I would expect some resistance or a pullback, especially if we continue in the coming weeks without a pullback, because we'll be very wrong tool. Clear that out. If that is the case, LQD will be very overbought, and then I'd expect a considerable reaction. However, if we can just come back in right now, actually I take that back. We already came back in. We're trading now at 117.82, so we're back to this support level. So even if we came back in a little bit more or not, we've at least worked off some of the near-term overbought conditions, and that might give us a fuel to power up to that gap. And it depends how quickly we get there. If we really work off the overbought conditions, it's possible we just punch right through there and then backfill the gap and then reverse. However, if we get there relatively soon, my expectation would be that we hit the gap, then pull back before building up the energy to go on and backfill the gap and maybe ultimately take it out. So that's what we're watching. Now, the other bond class that I watch are junk bonds. Junk bonds, some of you may know, are the one fixed income class that actually trades much more in line with the stock market and equities than it does interest rates. Government bonds, high quality corporate bonds, municipal bonds, those are typically more interest rate sensitive, and that's what drives their prices, whereas junk bonds, although there is an interest component to them, certainly they're the highest yielding bonds, but they're very sensitive to the economy, because if the economy is doing very well, the default rate on junk bonds are low. When the economy slows down, especially when we enter a recession, all of a sudden default rates spike. So what happens is, regardless of what interest rates are doing, you're losing value, and in some cases, tremendous amount of value. When a bond defaults, it can go from 100 cents on the dollar down to zero on a full default. And even if it looks like it's heading that way, when the economy starts to turn and the fundamentals of these companies turn, you start seeing those bonds priced down from 100 cents on the dollar to 80, 50, 40 cents on the dollar. So that's why junk bonds are more sensitive to the stock market and the economy. Now, when I look at this chart, what I see is a rising wedge pattern. I've already drawn that out here right now. This is what I'm watching for in junk bonds, bearish rising wedge pattern. We've had divergences building for quite some time. Now, a lot like the stock market. See, this was our previous reaction high. So this was a divergent high at this point, and we did have a correction from there. You can see the correction. But a lot like the stock market, if we can punch up a little bit, make a marginal new high here, for those not familiar with technical analysis, or at least don't see the charts the way I do, they'll think that's a bullish breakout. And, technically a new high is bullish from that point of view, but what I see is a bull trap if that happens, just like the stock market, like I went over earlier, because that will be a divergent high. We'll have these divergences intact, especially if the reversal, as I expect, comes, and I'd see a minimum pullback down to this T1 level, and quite likely any of these other levels down here. So that would be a scenario to watch for. And again, if this scenario plays out, it will most likely coincide with those scenarios that I talked about on the equity markets, which is just a little more upside and then a reversal. And the true sell signal won't be, you could certainly short a new high in equities and junk with a stop not too far above, based on where the divergences are and everything else that we'll look at. You could do that, maybe a partial position there, but the real true sell signal will come once that new high fails, once we fall back below the previous highs. That's where your sell signal comes. That confirms the false breakout. Okay, I think I'll wrap it up here. I was planning on touching on oil, some other commodities. I will say that the ones that I like, and I told you the other day, my favorite was wheat. Wheat since broke out, already hit that first resistance level and took it out. And for those of you that want to just have a basket of agricultural commodities, there's DBA, which also went on to break out, since I highlighted that the other day. So I'll get to oil, natural gas, and all those in either another video or another static post. But these are the areas that I'm looking at right now, and heading into 2017. Commodities, especially these ag commodities, precious metals, and still, not. We don't have those sell signals on the equity markets yet, but that's something I'm watching for, and I'll get into the individual sectors again in another post, semiconductors, things like that I'm watching. All right, this has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.